What goes up must come down. Well, not in some cases. I'm going to show you today what's been going up and hasn't gone down yet. There's a lot to discuss when we look at inflation and we look at why inflation happens in the first place. Let me get into it right here. The sticky high prices unlikely to come down anytime soon. When the prices of some goods and services go up, they tend to stay up. So it all depends on what we're looking at specifically, but in this article out of the Wall Street Journal, they do give us some indications as to the type of things that all through this inflationary period we have watched come up, and I know you're feeling it when you go to the gas pump and when you go to the grocery store. Some things have come down from their highs, and one of the examples that they give right here is the gasoline, which had gone above $5 and now $3.76. Prices for some other items, such as rent, change more slowly and mostly in one direction. And when the prices go up, they tend to stay up. And this could be absolutely destructive for a lot of people, because what they were used to paying for their rent, let's just say $1,000, suddenly becomes $1,500, and that is a huge difference. Yes, it's $500 when you look at it, but when you see it in a percentage basis going up 50% from where it was, and many people, what they were paying in 2019 to what they're paying now, in many cases, it is a 50% increase. So this is going to affect people's lives, their livelihoods, and so on. Rent is just one example. Here we have it. You could see other examples of some sticky priced services include haircuts, which have risen 4.4% from a year ago. Car repairs up 11%. Going on. They just give all these other examples, okay? And what happens to your restaurants? And what happens to every service that you use, essentially? Do the companies bring the prices down? No, because once the consumer says, I'm willing to pay, let's just say $20 for that haircut, they're not going to say, okay, well, inflation's coming down a bit, I'll bring it back down to 18. It doesn't happen like this, because as soon as you acclimate the public to something, they are willing to accept it long term, usually. There is one thing that could change this, and of course, if you start having mass layoffs, then everything is different. But right now, we haven't seen that. In fact, I'll show you something quite interesting related to this. First, home heating costs reach the highest level in more than 10 years. Families will pay 17.2% more for their home heating this winter. So imagine what you were paying. You're going to be paying 17% more on top of that. It is truly excessive to see this all. So you could look at natural gas, electricity, heating oil, propane, all fuels put together, just kind of trying to compare that and what the estimations will be. Of course, just like everything else, it has gone up, and you're not going to see it go down. Even though the area you might live in, you might say, we've got a lot of oil, we've got a lot of natural gas, what's going on here? Well, of course, there's so many steps along the way. There's the refining, there's supply chains, there's inflationary pressures from the central bank, and of course, there's always going to be profit coming from these corporations. In fact, they've made more money than ever before, okay? These companies have done so well. So those who invested in it, of course, made a lot of coin, made a lot of cash. This is the one I wanted to show you. Okay, you could see what was happening right now. This is the initial jobless claims and the continuing jobless claims. So the red line is the initial jobless claims. And can you believe it? You're watching this right now, before our very eyes, what's been happening. So Jerome Powell's been looking for an excuse. He's been trying to say, you know what, the jobs market, if we can just see this thing going in this one direction, we're going to be able to, reduce interest rates, and we won't have to worry about that. But basically, this was changed. So let me tell you like this. Earlier this year, at the beginning of April, we saw the initial jobless claims start to tick up, and that was what you would say, okay, now we're having unemployment. Okay, now we can back off. Now we can, really back off of our policies here. But we just reverse course month after month. And the same thing with the continuing jobless claims. So this is going against what the Federal Reserve, I guess, would have been hoping for. They can't go against their current policy yet because they don't have the data to support it. LME, London Metals Exchange, takes first step towards possible Russian metal ban. Now, let me stress, as they say here in the first line, this is a discussion paper. Okay, so that's the first step. Hey, let's put this out there into the public. We're not there yet, but it would be unbelievable to see this if you're going to start sanctioning the country in this way when you have a major exporter of something and you start to basically say, no, we don't want any of that. How is the world going to deal with this? The prices immediately jumped, by the way, but I think it is concerning, to say the least, what individuals will pay. If you're going to ban their oil, you're going to ban their gas, you're going to ban their metals, all of these things will add up, and ultimately it means you, the individual, have to pay more. Global market risk is building like in August of 2007. This is according to Larry Summers. Crisis firefighters had better not book vacations. Japan's bond holdings need watching as well. So all of this basically saying we are watching the same patterns repeat from 2007. These are just warnings. These are just predictions. And what he had to say is just what so many others have said. But I wanted to highlight this because it gives us a little bit insight into what we're happening. But the reasons for which are always going to be different. So some would say, no, we don't have a subprime crisis. No, we don't have the same issues with the banks. And these are the people that are very short-sighted, like horses. They've got their blinders on and they do not see what's going on in reality. But of course, you are here and I know you just want the truth. And you already know this, okay? That's the key. So what we see right now is just a matter of fact. We are seeing big concern, whether it's because of, the prices rising so dramatically, whether it's because of the interest rates that are being hiked at the fastest pace in history on a global level, whether it's, one thing or another, this all comes to a head at some point. Does it end in a hyperinflationary battle? Does it go down in flames like a deflation? We really don't know at this time, but I'm tracking it all. And of course, it is quite interesting. Key gauge of U.S. economic activity paints picture of weakness. Gross domestic income revised down to 0.1% in the second quarter, and just showing you what's going to happen, what we could see in the near future. When you have the activity being this minimal, well then, what does that say? Well, you cannot sustain, absolutely cannot sustain interest rates that are even to a moderate degree. Okay, the Fed funds rate at 3%. I mean, compared to the zero it was at. Okay, let's say they increased by 3%. That's a big chunk. But if you look at it kind of where we were, where we are now, it's a fair jump. I'll say that, but it's really not that tight. 3% is really not. Mortgage rates at 6.7% or greater, depending on the situation, is not historically that excessive. We're going towards those levels, but not yet. You're telling me the financial system can't deal with this? This is going to be painful, to say the least. Okay, look at this. High prices and rising interest rates are putting used cars out of reach for a growing number of car shoppers. That's bad news for CarMax, the nation's largest used car dealer. So this is showing us that, okay, the prices moved up so dramatically, there eventually comes a time in which it's just too much. And used cars is one, and you see it at other places. But I just wanted to show you that because we were covering this all through 2020, how wild and wacky it was with Hertz and all these different things. But now here we are. Okay, then we have this. Apparently, the Prime Minister of the UK basically saying, so initially coming out, okay, we're going to do these tax cuts, we're going to do all these things to stimulate the economy. The markets didn't like that. Of course, why? Because that means, inflation may pick up. And as a result, you're going to need to increase interest rates even more. And now they're coming out and, basically saying, we're not going to back off of this. We're going to keep going. We had to take decisive action. That's what she said. Whether or not they're going to keep it that way, that remains to be seen. This was in Germany, okay? Gas consumption in households is increasing too much at this moment. And then unbelievable, but look, okay. Without significant savings in the private sector, it will be difficult to avoid a gas shortage in winter. I just need to highlight how important that is. I mean, a gas shortage, okay, in a place where there shouldn't be any problem. Was Germany a healthy economy? At least it was. And suddenly a gas shortage? What are people going to do? There's going to be riots in the streets. There's going to be turmoil to a great degree. This has to be resolved. It has to be resolved. Here we are with the inflation sensation. Let's break it down right here. Understand that prices, the actual prices you pay for goods, can remain elevated for a long period of time, even when you're seeing the CPI number that they show you on the news. That could be declining, like I said, but the prices that you pay keep going up. And part of that is because it's these sticky things. And your rent, your energy prices, your food, those are the three major components that I really like to focus on, because if the latest iPhone costs another $100, you could simply say, no thanks, I'm going to pass. But for food, you really can't do anything else. And that's why you see more people going to the food banks today than before. Always remember that inflation numbers are year over year. So even if you get a 0% inflation number, that's compared to this time last year. So the prices can be still elevated, but they might not have grown since last year. It doesn't mean that they're affordable. Okay, that's important as well. And then we look at the next aspect, which is choose assets. When you're investing, when you're parking your money somewhere, choose assets that do well in times of inflationary pressure. Real assets. Those are the keys. Okay. And if you get into, let's say, a scalable business or high income skill, you want the kind of thing that is doing well during harder times. The example I use all the time is you can sell Tupperware, not that I'm telling you to sell that, but sell Tupperware, because maybe people aren't going to use disposable things. They'll say, I can keep my lunch in this Tupperware and I'll bring it to work. Okay, so that is the type of thing that people have that mentality. Yes, they'll spend, but they'll spend on something that will save them money long term. What can make this change? Massive demand destruction. So that's what we need to really get our heads around, okay? Because if this time right now we see all this upheaval, inflation, prices rising, what's going to make it change? Well, it's pretty obvious. Demand destruction, recession, or perhaps depression. Okay, so we look at all that, and I hope this was informative to you. If it was, you've got to subscribe to the channel. When you do, you end up supporting me, and I want to thank you for that. All of these details that I bring you here are just something that I'm looking into every single day. I try to give you those tidbits. I try to give you that really raw information so that you can be empowered. If you agree with me, if you support me, subscribe to the channel. I'll see you on the next one. Take care.